Let's check in on the markets now. Joining us from CommSec is Piotrowski. Tom, how were the markets overnight?
Well, Danica, the US markets ended last week on a fairly flat footing, it must be said. They clawed their way out of a substantial deficit. In the case of the S&P 500, in early trade, it was down by more than 1%. And that was a reflection of not only some much stronger employment figures that we saw, but also wages growth over the course of the month was much stronger than expected. And that cast a little bit of a pall over that narrative of last week where investors had really reeled in expectations of aggressive rate hike from the US Fed. But towards the end of the session, that seemed to balance itself out. We saw the S&P 500 finish down by 0.1%, so it recovered by 1%. And then importantly, in weekly terms, the decline in long and short-term interest rates was still largely preserved. So over the course of the last week, 2 and 10-year Treasury notes roughly were down by around 0.2%. So that highlights that scaling back of expectations of a 0.75% rate hike from the Fed to 0.5%. At the hands of the moderating figures that we've seen in relation to US inflation over the course of the last couple of weeks. So it ended up being quite positive, I suppose, in that respect, that tech stocks were the main weakness. We had some weaker earnings numbers out of that space, and that tended to weigh on the NASDAQ, which was down by 0.4%, still up by more than 2% in weekly terms. The S&P 500 in weekly terms was up by 1.1%. So locally, we're going to kick off with a gain of 0.33%. Our thoughts are going to be moving towards tomorrow's interest rate decision from the RBA. On Wednesday, we've got growth figures as well to look at. So it's quite a busy week as far as this week is concerned, with economic news both locally and abroad. So it'll be interesting to see not only how stocks hold up amidst all of that, but how interest rate markets conserve that fall that we've seen over the course of the last couple of weeks.